Mike's right. What's up, guys? Good morning. It is the day before the 4th of July. Everybody's very excited about the 4th of July. I'm not the biggest fan. I enjoy people getting together. That's great, but I'm always trying to. You guys know I'm always online on the holidays. I like to do things on the holidays, and the market to me is like something that's just a part of me. Like I'm always doing it. I'm not like trying to take time off to get away from the markets most of the time. Most of the time, it's the other things that are frustrating. But really, when I'm looking at the markets and trying to get an understanding of trading and so on, I love to do it on holidays. I love to do it on weekends because that's the time that nobody's around, nobody's bugging you. You can kind of look at markets in a very objective way. And that's what we want to do here at all times, even when the market's open. So, looking at a couple things today, there's a bunch of things to talk about. But first thing to talk about is this heat wave that we're in Kashop. So, I was just talking to Kashop offline. I'm in Ohio. It's very humid and it's like 100 degrees and it's pretty rough. I went outside. I played basketball with some people the other day. Only people that showed up were like 20, and I'm over here at 40, like trying to keep up with them in this heat, which I did just fine. But I went home and like I literally went through while I was playing. I went through two sets of clothes, and I basically went home in my underwear. Like there was not, I had nothing else that was working at that point, and I just jumped in my car and went home, and everything was covered in sweat. It was terrible. But at the same time, it was like, man, it's just been very, very hot. So, what's it like out by you, Kashab? Because I know you're in even warmer area than I am.
So this is the hottest time of the year. So we just entered the 40-day phase where it gets extremely hot and you start to get advisories saying do not go out in the afternoon. So it's going to peak at something like 46 degrees Celsius, which is 115 Fahrenheit. And out in the desert, it's going to go to 50. So it's going to be a crazy time. Luckily, we have air conditioning. So that's the best part, I think. Like, I look at all those people in Europe complaining about a heat wave, and they're like, oh, we're not allowed to have air conditioning at home. And I'm like, what? That's crazy because out here, if you don't have air conditioning, well, you're kind of screwed. But yeah, this season, actually, I like it here because we get a lot of offers. The tourism crowd dries up. So everywhere you go, it's like you get cabs everywhere. The stores are kind of empty. The mall feels good. And then we have all these indoor events. So, I mean, I think it's going to be ridiculous to say this out loud, but I like summer in Dubai more than I like winter. I mean, I do love winter, but then I like summer in Dubai because it's kind of peaceful.
Mhm. I like the warm seasons. I mean, honestly, like I like the heat. I'd rather heat than cold. I do like to do certain things in the winter, but at the same time, I'm like I'd rather just be extremely hot than extremely cold. And yeah, everybody. That's the funniest thing to me that I always kind of laugh about with the climate change movement or whatever. Is the fact that you have so many people who push this, and it's like it's all for us, it's all for you guys, we're doing this for you guys, we're doing this for the earth, we're doing this for this or that. It's like there's very simple things to just kind of debunk that very easily, which is, hey, what's the most destructive thing that we do to this planet at all times? Well, if you're talking about the ecosystem, you're talking about bugs, you're talking about animals, you're talking about even humans, like it's extremely detrimental to our health as humans. It's the using of pesticides, Roundup, glyphosate, and so on all of our food products, especially here in the United States. It's really, really prevalent here. I mean, there's even stories of there's those wildfires in California. They were like, okay, how do we just get the trees out of here? And then basically kill off everything else. Well, they just doused all the land with pesticides to do that. So I mean, it's like that's really, really detrimental. I mean, it kills everything. I mean, it's funny because I talked to a guy this was probably a year ago or so. He was using Roundup on his yard he had his baby in his arms, and I wasn't gonna say anything. I don't try to get involved with parents and kids, like that's always a bad thing. But he did this like every single day, and finally one day I went outside and was like, "Hey man, like you got to think about that Roundup. Like, what are you using it on?" He said, "My grass." I said, "Okay, so." using on your grass. If you pour that on a bug in the grass, what happens? He said the bug would die. I said, okay. You pour that on a mouse in the grass, what would happen to the mouse? He'd say, I don't know, it probably gets sick and probably die. I said, okay. I said, what about if some of that gets on your baby? Like let's just think this through a little bit. But the answer is it's actually interesting, and I'm not going off an entire tangent, but like there's tons of studies about neurological conditions and MS and Parkinson's and so on that is brought on by Roundup, by the use of it, the use of pesticides in the United States, and so on. So it's like we don't really like there. That's a simple answer to say, hey, we're just not going to use that anymore. But at the same time, who's running the FDA now? Well, it was the old CEO of Monsanto. So it's like they continue to make these things up, and at the same time it's like, yes, let's complain about the air conditioning, let's complain about all these other things, and never just talk about any of the problems that we're not supposed to talk about. So it's pretty fascinating when you really think about it. But yeah, I think it's a very interesting time in the world, and something that's also happening because we're running out of the interesting thing, and this, Gashap, is that we go from heating cycles to cooling cycles. And we go from you go back to, was it the 70s, and there was the global cooling scare. Like a lot of people don't know about this, but look it up. It was all about global cooling. It was going to be the end of the world. We were going to go back into an ice age. We're all going to die from global cooling that was going to happen. And so this was the thing. All the scientists were going to get together and figure this out. This is when peak oil theory and all this stuff started to come out in the first place. And then as the years moved on, it moved into global warming. Now we were actually heading back towards a cooling spell, even though like right now, yes, we're in a heat wave. Once again, just like any trend, doesn't mean it goes straight down or straight up. But now we're kind of heading back towards a cooler period of time. And people say that that's impossible. Hey, the emissions, the carbon, the this, the that, whatever the hell they're talking about, they say that that's impossible. However, in a couple, like you've seen the last couple winters, we've been getting hit a little bit harder. We'll continue to move that direction. And the cycles kind of go back and forth where you're in cooling periods, heating periods. Not saying, hey, I want to go put my mouth on an exhaust pipe and that's going to be good for me. I'm just saying that that's the way the cycles work. If you go all the way back, and it's interesting, it's a very easy thing to test because you can go back to the North Pole and look at the carbon dating, basically pulling out ice that goes all the way into the earth that's been preserved for many, many years, and figuring out what the temperatures were back then. And figure out that we've been going through hot and cold periods for many years. I mean, if you believe in the dinosaur theory, and if you believe in prehistoric times and so on, like that there was more carbon then, that we went into an ice age, all of these things that we kind of have moving forward. And so now we're here in this heating period that's moving into a cooling period. And what that usually does is creates a lot of movement in commodities. So when you start to see this cooling period come up, if you overlay commodity prices on top of it, you'll see the commodities usually make a big move during these periods. So it's going to be kind of interesting going forward to see how much that really affects us. Like maybe that's changed. Maybe I'm wrong. Maybe everybody's right, Kashap, and maybe the driving and you using your air conditioning too much has changed that completely. So maybe we won't head into that cooling period ever again. We'll just get hotter and hotter and hotter. And next year we'll talk about the heat wave that lasted from June to August until we all burn to death and die. Anyways, let's get on to the markets. So much stuff to talk about.
No, so you have spent lot of time talking about. I mean, I know you're very knowledgeable about this. So the El Nino cycles, the weather patterns, like how does it affect the softs, and where do you think does that play a factor in your model? Is that something that you pay attention to? And for someone who is new to softs, someone who is new to this whole space, how should they be thinking about this?
Yeah, so when I think about the cycles that happen, now that we're kind of headed towards the different part of the cycle where we're kind of changing into a kind of cooling period and so on. But the thing you have to think about, and this is the hardest thing to kind of do, and this is why it's almost unpredictable and predictable at the same time, which is if you're looking at, Brazil, they're going to have a different period during those times, a different cycle. The United States are going to have a little bit different of a cycle. Globally, you could say we're headed towards this period, but most of the times, all of these things are on different cycles. So I really take it the softs, like once again, you're looking at coffee is also the other place, mainly Brazil, mainly South America, but also like there's a lot of production in East Asia, Southeast Asia specifically. So like you got to look at these different areas and see what the weather patterns are doing at these times. Like for example, I think it was, what was it, was it this winter or last winter? It was one of these recent winters where we were really really cold in the United States and Europe was warm. And so, like, everybody said, global warming is happening. Look at Europe, blah, blah, blah. And then we're in this other period that's very, very cold. That's very normal. And so, like, you have to understand what the crops are. I was explaining this to somebody the other day. What are the crops that are in the United States? Even though wheat was kind of imported, that has been a U.S. crop for many, many years. We've thought of it as a U.S. crop. So if you look at agricultures or ags compared to softs, you got wheat in ags, you have soybeans and ags, you have corn and ags. Those are the three majors. And then if we get to the softs, we're looking at, we've got cocoa, we've got coffee, we've got lumber, we've got cotton, and sugar. And so what are those, the three main ones? Coffee, cocoa, sugar. Where are those located at? Where are those mainly grown at? Well, we're talking about South America once again, Asia, Africa even. So these are crops mainly grown outside of the United States. Yes, we do have production here in some areas, but not as nearly as much as these other areas. So you have to understand the different areas. For my model, do I really use it a ton? I look at it, I pay attention to it. I think it's something that's good to help build conviction and a thesis or something, but am I going to buy or sell anything based on it? Not exactly. It's kind of like seasonality as a trader. It's like, do I look at seasonality and make decisions as a trader? Absolutely not. From time to time, I'll post a chart, and it's mainly to say, like, this is what I'm looking at. If the seasonal pattern is bucked here, and let's say the price goes up and the seasonal pattern says down, I will think something because of that. Or if it's just following the seasonal pattern, that will kind of help me build conviction. But that's about it. But overall, it's like the softs are getting very interesting. Actually, I brought some charts about that today. We'll get that in a bit, because man, they're looking pretty good. Kashop, have you been paying attention to the softs?
Well, I've been looking at sugar, but that's mostly because in India, especially, there's a lot of buzz about having higher ethanol blending requirements, mainly because of the war. But I haven't looked at the softs because, I mean, honestly, it's been a disaster. Whether you've been trying to trade fertilizers, whether you're trading wheat, whether it's corn, it's just been such a difficult trade that I wouldn't say I've given up on it, but I'm close to giving up on it right now.
Understandable. We'll hop to that and then we'll hop back here, because I think this is kind of an interesting thing to kind of show something that's changed a little bit. Now, once again, if you look at the charts, like you're seeing, we've got long, for the first time in a long time, I'm long cocoa and coffee. It's been a long time since either one of those has been on the radar. Sugar is starting to get on the radar. And if you look at it, there's reasons why. If you look at the list, like all the way down is sugar is negative on the year. Coffee is negative on the year. Cocoa might have made its way up by now. I'm not sure. Where is cocoa on the list? I'm missing it myself. There it is. Okay, so cocoa's still down even with this crazy rally that's happened. I expected it to possibly be up. But if you look at the 1 month performance, at the top of the chart are all the actual soft commodities. So what we were talking about earlier is the difference between ags and softs. Ags are your wheats, your soybeans, your corn. Softs are your cocoa, coffee, orange juice, lumber. And so you see the softs are all hanging out at the top here right now, which is a big change. They have been dead in the water for as long as I can remember currently. But that's an area that you want to keep looking at. And here's the hard part, because everybody's going to say, well, what do I invest in then? Well, guys, nothing. There's nothing to invest in for in the United States. I hear people all the time who are like in Britain or Europe, and they're like, oh, there's an ETF for this here and this ETF for that here. That's awesome. I'm excited for you guys. Definitely to trade those. But if you're looking at exposure and trying to gather exposure for these, DBA is about the best you're going to get. It's a good fund. It's managed well. They usually are using whatever's the strongest commodity. They're usually in that the most. They let the positions ride. They let them compound together, and they have good returns. good ways of managing it that I am always impressed with. So that's the way I would take advantage of it, because it's the only way you're going to really get exposure to coffee, cocoa, orange juice, lumber, and it also has ag exposure too. So soybeans start running, you're going to be long soybeans. Wheat starts running, you're going to be long wheat. So I like that for a good diversifier for a long-term portfolio. So definitely take a look at that. But let's get back to this, because Kashop, as much as we talk about things, we both know there's always a very specific thing. Like there's a analysis is great. We can talk all day till we're blue, and basically just continue to talk about what the analysis is saying about the markets, what the intermarket's saying, what the fundamentals are saying, what the macro is saying, and so on. But at the end of the day, there is a very specific thing that you have to understand about trading, because it's a math thing. So the math comes into fruition most of the time, and that's something that you have to think about as a trader, which is how do you weight your portfolio? How do you use stop losses? How do you manage risk? This is the most important thing as a trader at all times. So I brought this today. I thought this was great. This isn't mine, just found it online. But I'll probably make something similar at some point. But this is kind of showing risk per trade. Now, risk per trade and then the account balance. So, everybody out there, I use an even number just to make it easy for most people, but this is a way to break it down for yourself. And you could probably pump this stuff into, nowadays, you probably pump it into AI, and AI will pump out an actual portfolio model for you guys, which is kind of insane. But, once again, that's where we're at currently. So looking at it here, if you have a $5,000 account, 1% is $50. So meaning your risk per trade is $50. And once again, like you have a smaller account, you'll probably go a little bit larger than 1% risk per trade. So this will keep you in the parameters. Now remember, you risk 1% per trade. You're only losing 1% per trade. You're losing 2% per trade here. You're losing 3%. So as these numbers go up, you're getting closer and closer to a blow up. Basically, once you're at 5%, you have 5 losing trades, you're losing $1,000. That's kind of changing the game. Sorry, 4 losing trades, you're losing $1,000. That's kind of changing the game for you. So that's why we talk about like having smaller position sizes. You kind of want to be in this area, especially as you're learning. I think this is a really important thing, because learning as a trader is something that a lot of people don't understand. It's like learning as a trader is, my story learning is blowing up, trading way over any of this, like probably like 20-30% risk per trade, with no idea. I think I'm going to make all the money in the world when I take a trade, and blowing up my account over and over again in terrible ways and being very depressed about it constantly. So that was my learning experience as a trader. And what I always tell traders is like, you're not going to probably make money your first couple of years. I had a friend of mine who was like, I want to start trading. And he was like, yeah, I'm thinking I'm going to do this. And he's like, how much money do you think I could make this year? And I said, your first year trading? I said, are you buying and holding? He said, no, like I'm going to trade in and out of positions. I said, are you using options? He said, yeah, options, whatever. I'll do everything. I said, you'll probably only lose, maybe 80% of your account. And he got super pissed off at me. Just didn't talk to me for months, and basically came back like 6 months later, said, hey, I blew up my account. And like, yeah, that makes sense. So, it's completely normal to do that, but how do you avoid that? And that's risk management. Now, the best use this. So it's a way to make money too. So it's making money, not losing much money. But when you're making mistakes, like, because we all make it's not even mistakes. We're all going to have losing trades. There's no period of time where every single trade is going to work out. There's even going to be like, I could have a great year. And I've shown people this. I think 2020 is the best example of it. I spent most of 2020 in drawdowns. Drawdown from January to February into March, had a really good return, and ended up at a new equity high, and then was in a drawdown basically until that would have been all the way up until October of 2020. We started to have Bitcoin moving. We started to have the financials started to move. A couple things started moving as well. And then December, everything really took off in a huge way. Had 2 really good back-to-back months, but most of that year was just losing trades in a drawdown, a lot of pain, The only way you survive that is by having proper risk management. So that meant everything to me that year, and it usually means everything to me every single year. So the more you're able to manage your risk properly, the more money you're going to be, the more money you're going to make. So next up is loss of capital. And so, Kashap, if you have anything to
Yeah,
actually add on,
I do.
risk management, go ahead.
No, so we just got a comment saying I haven't told any stories about blowing up accounts. No, trust me, I have blown up plenty, and I do talk about it in the newsletter. In fact, I think that was the first article that I wrote where one of my very first trades, in fact, it was on silver. I had an option go from 2 cents to $1.50, and I was like, "Damn, this is so easy." And I mean, I was a gold bug at the time, so I was like, "So all you really have to do is buy gold and silver, and then maybe buy options on those, maybe buy the gold mining stocks, and you make money every day." And there was a period where this was actually true. So if you go back to uh, July, August 2016, they pretty much like the way semiconductors are going up now. So anyone could just launch a company and say, this is a gold exploration stock. I'm raising $1 million to drill a hole, and boom, the stock would go up 100% in a day. And like, I'm not kidding. There were tons of these stories in that era. And I got schooled in that era in the sense I made a lot of money in percentage terms. And then all of a sudden that bull market just ended. And even though I knew commodities are cyclical, I was kind of not prepared for it. And by 2018, it had gotten completely miserable, and I ended up exiting a lot of my previous winning trades at a loss. Not all of them, but yeah, I mean, that happened. And COVID, I think it was November 2019 when I decided I had this big thesis where I thought offshore oil drillers, which had been in a bear market for 5 plus years, they're going to suddenly start performing. Like they're going to lower their debt, which means, the leverage decreases, which means higher earnings, which means a higher profit multiple. So, so on and so forth. And what ended up happening was oil went to zero, and most of these stocks, some of them went bankrupt, most of them just went down to $1, $2, and it looked like they would never recover. So I had lazy blow-ups during these learning periods as well. So the difference is that I used to risk a lot more than 5% in a trade, but the good thing was there was this point where I was pretty much long only, which means even if you risk 10%, the position size is 10%. So the stock goes down 50%, you're down 5%. The stock goes down 100%, you're still down only 10%. And that is hope for recovery. Now, you do that in futures, you are going to blow up a lot more. So I was lucky in that I had a lot of these lessons when I was doing long only equities, just that I got the timing wrong and blew up plenty. And here's the thing, I still say there are times where I blow up, but instead of going down 99% on an account, now maybe I go down 20-30% on an account in a short period of time. So what you consider a blow up has gone from I've lost it all to, oh shit, I've taken such a big loss. And that's really, I think, the evolution of my trading. It's not about, oh, I don't make mistakes at all. No, I make plenty of mistakes. I have plenty of high conviction trades, which I probably shouldn't have. And at the end of the day, I take a big loss on one or two of them, and then I just lick my chops and move on to the next one. And ideally, I know I shouldn't be doing that, but that's what happens when you play the dual role of both an analyst and a trader, and you say, how can my fundamental analysis be wrong? And sometimes I do get into those situations, but the beauty of it is the blow up is now 20-30% rather than down 99% or the account going bust.
Yes, that matters a lot, because it's like you just and 20-30% is just a drawdown. Like that's the thing at the end of the day. Like there's no, like, look at every single fund in history, and this is the thing I always tell people to do. Like if you can find returns from, like, any of these guys. I know Paul Mulvaney's are always out there, he's always updating them, but any of the guys that have funds, go look at them. I don't care if you hate them, you don't agree with what they do, it doesn't matter. Go look at them, because everybody who you're like, that dude is a legend, that dude makes so much money, he's a killer trader, they're in drawdowns all the time. Like there's none of them that are just in, like, the market doesn't just go straight up for them. I wish it did for any of us. That's not how it works. It's really a set yourself up properly. You're chopping around. Maybe you have a little bit of a drawdown, you're chopping around, and then you're set up properly. So when something happens and you're in the right trades, then everything starts working together, and then it's boom, you made a bunch of money very quickly, and then you're back to flat or drawdown, and then you're going over and over, and you're getting frustrated again. I mean, for me, it's like I don't get frustrated by it anymore. I just know the way it works. Like, that's the way it works. There's nobody's system. There's nobody's trading methodology. There's no fundamental technical person in the world who just is like, yeah, all my monthly returns are always up. That's never happened. And there are some, like, you could have some algorithmic fund that's like from Goldman Sachs, and sure, you can, when you're running 50 billion, sure, you can kind of move things around, and you can make a couple percent here and there, and you could have every month around like 1 or 2% and so on. But most of the time, even those blow up over time. When you try to, every single person I've ever seen who tries to have a fund where they're just going to gain 1 or 2% over time, or some strategy, or selling options, and Kashap and I know this, there's everybody in the world from the time we were growing up to today has tried to sell options to just make income. Most of the time that backfires. And when that backfires, they lose everything, because it's like, yes, if you're right, and you're just right in with a big margin with selling options, you're going to make money. But all that has to happen is something to move against you. I've used the optionsellers.com person a bunch of times to illustrate this, but this was a company, it was, 2018, when basically oil started crashing. So oil was going up in 2018 most of the year. Then it all of a sudden started crashing. They were selling naked puts, so meaning they were betting on the price to go up, and if it went against them, they'd lose a bunch of money on oil. And then with natural gas, they were doing the opposite. They were selling calls on natural gas, thinking it would never go up again. Next thing you know, that relationship completely inversed. Natural gas just exploded higher on some supply issue, and then oil just started drawing down pretty nastily, pretty quickly, as the Fed was tightening rates. And then next thing you know, there's no more fund called optionsellers.com. And the guy's making a very entertaining video. I feel bad for the guy looking in hindsight, like, damn, that had to really suck. But like, you reap what you sow. You're selling options. You're going to lose money at some point. Everybody wants to create a strategy that wins all the time. There is no such damn strategy that wins all the time. You look for it. And that's the thing I think we all do when we start trading. You look for the strategy that's right all the time. This is a thing that, the mainstream media will never tell you. You want a strategy to be right. So then you go and you build these things, and you're like, okay, I'm a technician. I have 50,000 indicators, and I'm looking at breadth every day. I'm looking at thousands of charts all the time. I'm doing all this stuff all the time. And I'm going to figure out the holy grail of getting all these trades right all the time. You don't. It's impossible. You could have all the information in the world. You will never get every single trade right. And then on the opposite end of the spectrum, it's hey, I might be right 40. Like, if you look at somebody like Mulvaney, hey, he's probably right about 40% of the time, maybe even 30 some years. Dude rips the face off the market most of the time. He crushes returns. He does very good. He's had periods of bad times, just like any other trader, but he does really well for himself and his fund over time. And so, like, you just have to know what type of trading you do. It doesn't matter that, like, you don't have to be right to make money. You just have to continue to execute your strategy and do the right thing. So let's see. How did you get good? Oh, this is a great question. Oh my God, I love this. So, Jason, how did you get good at trend following if it was such a poor strategy in the 2010s? So let's talk about what was wrong with trend following. Nothing's wrong with trend following, but let's talk about how they were allocated in the 2010s. So the allocations were very commodity focused. Commodities did nothing. Very Forex focused. Forex did nothing. And so, like, what was really the thing that you needed to really buy in the 2010s to make money? Well, it was really technology. So what happened? So trend following, even the futures trend followers, which I have a ton of respect for, so I'm not hating on it all. Even the futures trend followers didn't do terrible during those times. They just didn't do insanely well. And then as you move into 2018, 2019, 2020, they start to pick up once again. They start to outperform. Once again, there is no strategy that's right all the time. There will be people who are buy and holding who are crushing me some years. There will be people who are trend followers who are crushing everybody some years. There will be people who are option sellers who are crushing people some years. Every strategy has its upsides and downsides. But if I'm talking about trend following, going back to then, one is you want to understand. For me, the biggest thing that kind of separated me is understanding the environment, because I look at it and go, okay, most trend followers I knew and the guys I learned from, they will trade everything all the time. So if let's say gold is in a bad environment for gold. That's not exactly the case right now, but let's use this as an example. So gold's in a bad environment. None of my models say like, hey, it's time to buy gold. This is where my fundamental macro models kind of come in. And I would go, okay, well, I'm just not going to trade gold in that type of environment, or maybe the yen, or maybe silver, none of these precious metals. I don't think that's anything but a short in this environment. So I will trade it as a short in this set environment, hypothetical currently. And then let's say I'm long technology. Let's say I'm long semiconductors. Let's say I'm long bonds, all of these things, certain currencies, probably the US dollar at that point. So that kind of identifies like the different regimes and environments, and that will help me to make a lot more money than other traders who are just trying to trade everything. Because if you're trading everything and nothing's really working for you, your diversification's there. Your drawdowns are probably going to be smaller than mine, but the other part of it, your upside is going to be a lot more capped than mine as well. And so backtesting that strategy, I found out that makes a lot more money in the long run than just buy and sell signals based on like a trend following model and a backtest. So not hating on the way they do it. I think there's plenty of room for them to do it their way, plenty of room for me to do it my way. It's just differences in opinion. So
let me
go ahead.
ask the same question in a slightly different way. So everyone gets into the markets. I mean, if you're a professional and you go into a trading firm straight out of college, which I know is not the case with you, like then it's different. But anyone who starts on the retail side, they start with equities. So how is it that you started? And if you're doing only equities, I'm sure a trend following model is not the best way to do it, because there are lots of other ways to trade equities. So how did you get into, I'm going to do trend following on currencies, commodities, equities, everything, the whole lot, bonds, all of the assets that you can? Like, how did you, rather than say, this is my lane, like I'm a gold guy, like I got my career in Indian equities, followed by gold mining stocks, and then I diversified. So how did you get into trend following futures specifically, rather than get a more narrow focus in your initial years?
That's interesting. I mean, I guess it comes from what I learned from my uncle, which is like just investing in whatever is working. Like it wasn't for me, that was the best lesson I ever learned, which wasn't exactly told to me in that sense, but it was like, hey, I'm watching this guy invest in commodities, then tech stocks, then micro caps, then gold miners, whatever it was. He was always kind of moving to different things. And so like when I first started, like I didn't really have like a lane that I wanted to be in. It was, and at first it was, hey, whatever stocks I thought were going up, I would do that. Now that's, once again, terrible way to do it. That's my starting point, probably a bad starting point, using fundamentals, technicals, whatever, to try to get an understanding of things. I don't think now, looking back, I don't think 20 years ago I had or 15 years ago, 16, it's 2008, so 18 years ago now, I don't think I had any idea where the hell I would go with that. And then as the years went on, it was, okay, well, I'm gonna try to invest in this area, I'm going to try to invest in this area, and then being more specific about it. Where's the relative strength at? Because that was the one thing that really kind of taught me a lot, was reading, Meb Faber's papers. Meb Faber has a great paper on relative strength investing. So relative strength investing told me so much, which is, if you invest where the relative strength is, you're going to make more money than the people who invest where the relative strength is not. So that sounded so counterintuitive to me that I actually hated that idea at first. But I realized I was doing the opposite and I was losing money. So maybe try that. Okay, well, that's sector wise. So, okay, I'm looking at ETFs. I'm understanding which sector to be in. At that point, I couldn't trade futures. So I'm just trading these different sectors. Then you're adding commodities. Okay, well, gold is showing relative strength or silver is not, whatever it is. And then so you're getting long specific commodities that are showing certain types of strength. And then moving forward, like it's like, okay, now I've added currencies. Now at that time, it was just some Forex. Currency ETFs were a thing at that point. I don't know if I'm sure they still exist, but I haven't looked at them in so long that I don't even know if they exist anymore. But currency ETFs, commodity ETFs, bond ETFs. So then I'm starting to get into all those different areas. And it took a long time because a lot of people, will always talk about, trading futures. Somebody was talking about coffee yesterday. It might have even been SM Traz. And somebody's talking about coffee futures. And they were like, yeah, the Interactive Brokers list coffee futures. And they're like, yeah, you can buy coffee futures. I think it's the margin you got to put up is 28K. And then you get, $127,000 contract. So it's a very large contract, a lot of money you have to put up to buy this. And so people will always ask, oh, I can't trade this. It took me years, like I want to say like 7 or 8 years before I could comfortably trade futures. And then it was a continuation of, okay, well, I have all these micros and minis. So I have micro futures, which are the smaller contracts. Minis are the contracts. So I couldn't trade things like coffee. I couldn't trade things like sugar. I couldn't trade any of those in the futures market. Sugar was actually pretty small, but most of the other ones like coffee, cocoa, palladium was one that I couldn't trade for many years. Those were not even on the radar for a long time. So something like palladium was something that I would always think about and be like, one day I'm going to trade that contract. Especially because like when I first wanted to trade that contract, it was when it started that new big uptrend, and I didn't get to trade it until it was kind of in that uptrend for a while. And then by the time I was in it, I basically didn't really have a good trade in it. So if you look back, I think that was 2016 to 2018 or something. It had a huge run. I can't remember. But it had a huge run back then. And I was just like, man, I want to trade that contract. Because really, like, you're talking, that's not 100,000. That's not 200,000. That's not 400,000. You're talking a $500,000 account to even trade that comfortably. And so and then over the years, you keep building that your cash behind you. And now I'm to the point where it's like, I can trade anything I want to. I don't have anything really holding me back anymore, any of these bond contracts, but that took years. Like that took almost decades at this point, to get to the point where I'm at today, where I can trade whatever I want. That's why I always tell people, you want to think about it in your head. You want to think, and this is the hardest thing to do as a trader, is think about in your head that point you want to get to. You want to get to that point where you're trading palladium contracts. Think about it. Look at that contract all the time, like you're going to trade it anyways. Maybe to open a paper account and trade it, whatever you have to do, but get it in your head that one day you want to trade it, because one day you probably will. And that's it's almost a manifestation idea, but at the same time, it's like, I think you have to have that ability to see that to get there at some point. And the more you're kind of building that portfolio up, you kind of have more strategies, you understand diversification a little bit more. People always ask like, oh, you have so many positions in here. Yes, your positions, you add to your positions and you have more positions. Like look at somebody like Buffett. How many positions does Buffett have? He has a fuck ton of positions. When can you have a fuck ton of positions? Well, the answer to that is when you have a lot more money. When I started and I'm trading, $1,000 or $5,000 account, or even a $10,000 account, I don't have, 30 positions in the portfolio. I don't have 20. I probably had under 10 until, you get to like 30,000, 40,000, 50,000. So it's all based on that amount of money that you have, which makes you able to trade more and more positions in your portfolio. So I think that's also like really important to understand. Like there's different levels to this game, and it doesn't mean that like you're better or worse than somebody, but I can definitely look at, hey, I got good returns, and somebody will bring up once in a while, you've got better returns than Warren Buffett. That's true. I am not running the amount of money that Warren Buffett is. I could not do exactly what I do running the amount of money that Warren Buffett is. I'm not running an inconsequential amount of money, but I'm certainly not running into $100 billion. that would be really cool, but you'd have to trade completely differently. The softs we're talking about today, even Kashop and I bringing up lumber, orange juice, cocoa, coffee, are probably too illiquid to trade with that amount of money. So like I'm able to kind of be nimble in the area I'm at, but you just kind of got to figure out the trader that you want to be.
And let's not forget, if you look at the old Buffett partnerships, the trades he did in the 60s and 70s, he made a ton of money. He took a lot more risk and he compounded a lot faster. Now, of course, he's 97, 98. He's going to slow down. And I think once you're past, I don't know, maybe 40, 50, I'm just throwing out a number, you probably get a lot more risk averse because you have a lot more to lose than what you have to gain, because at that point it becomes asymmetric the other way. A guy with a $5,000 account and a job that pays you 5-10K a month, you're going to take a lot more risk, because worst case scenario, your cash flow is going to cover your losses. Whereas when you're in Buffett's position, you really want to make sure you do not take those big losses, because that's what helps you compound. So the calculus kind of flips once you change your AUM, once you get older. So you cannot really compare Buffett to others. It's just apples to oranges.
Yes, and that's the thing that's important, is understand that difference, but also understand like you can take, they're going to have drawdowns just like you are. They're going to look much different, because if they're only gaining 10% a year or 20% at most a year, like, and you're looking to gain like 100 or something wild, like of course your drawdowns are going to look much different. You're taking a lot more risk than they are. But at the end of the day, it's like you have to understand that difference, and like monetarily, starting from a small account to a big account, from a large account to a insane account, which is Buffett's fund, for example, or Buffett could trade his own money and it would probably be insane on its own. So that all matters as well. So getting up here, looking at this chart, and I've brought a bunch of these over time. You guys have seen this before, but you're going to get it again. You'll probably get it again in a couple weeks. But percent of loss of trading capital, if you lose 10% and then the gain to recover the loss. So 10%, 11%. This is the reason why, I said earlier when me and Kashop were talking, I said, hey, that's just kind of a normal drawdown, 20, 30%. It is normal. It's once again, it's like the drawdown. If you have a fund, you're like, I really don't want to be in a 20 to 30% drawdown, but it's manageable. Why is it manageable? Because you don't have to make that much to make it back. Once you get to these numbers, you're really kind of getting hit. Even 40%, like that's not the worst thing in the world. But once you get to 50% drawdown, 60% drawdown. So this is why things matter. And you have to have like parameters around your trading to do this. Some people just stop trading. Hey, I got to 40%, I'm out. Like I'm going to take a break. Something's wrong. I'm not making sense of myself. This is more the discretionary people, the fundamental people. Like you're not in tune with the markets, stop trading. That makes sense for them. Systematic traders will go, okay, well, my system says I can be in a, once every 5 years or once every 3 years, I can be in a 50, 60% drawdown. So they will just continue to trade their system. That makes sense for them. You just have to figure out what the parameters are around yourself as a trader and then do it that way. And so, Kashop, I wanted to talk a little bit about portfolio construction. So this is Ray Dalia's all-weather portfolio. So, so many people talk about the idea that, when you want to just be long technology, right? Like, hey, technology is the best sector in the world. It's been performing so well for so long. You just want to be long technology. Why would you diversify? And then there's other people who preach diversification. I'm a person who definitely preaches diversification in a way very similar to Ray Dalio's way. But Kashop, what do you think about the idea of, either going all in, or basically having some diversification? We're talking long-term portfolios here. We're not talking like portfolios that, you're going to be in and out of in a week or whatever. We're talking like this is a retirement account. I want to hold this for 5 years at least. So what are you thinking about that?
So I have an article on my site called The Permanent Portfolio where I go into exactly this question. And my take on the asset allocation here is you should have something like I mean, this is rough. So this is based on the Harry Brown model. So
Mhm.
my thinking is that you should have 25% in gold and other commodities, 25% in equities, 25% in real estate, and where Harry Brown says you have 25% in long-term bonds, I say you should have 20% mix of cash and bonds, which is across maturities, and 5% in cryptocurrencies. Now, cryptocurrencies and real estate didn't really exist as separate asset classes when these old allocations were done. So that's the change that I bring to this. The other thing is, I don't just say, let's have this much in gold. I say, there is a time when, for instance, you look at the gold silver ratio, the gold copper ratio, there's a time to be more overweight on gold, there's a time to be more overweight on copper, palladium, and other things. So you switch that around. And with real estate, so the other thing that I bring to this is, everyone has, if you look at general person's net worth, you own your home, you have a 401k, you have a paid off car, you maybe have a vacation home, uh, and then you have some equities, that you have in an account on the side, and some mutual funds. Now you drop the allocation of someone like a typical corporate executive, it is going to be heavily skewed towards real estate. Like 80-90% of their net worth is going to be in their home. Now that's a scary percentage. So when I say 25% in real estate and people come to me and say 25% in real estate is a lot, well, I'm like, well, a lot of people are at 90-100%. They are in fact levered into real estate because that's the way the model works. You take the cash flow from one property and then you buy the other. Especially in Dubai, it's so common that people buy something called an off plan, which is you pay 1% of the property value every month, and then whenever the construction is done, you own the property, which is like a lot of leverage. Not saying it cannot work, it's just a lot of leverage. So when you think about a portfolio, I think generally your equities allocation should be higher than what is advertised. Your bond allocation should be lower. Your gold allocation should be a lot higher. And your real estate, if you already own your home, it should be a little lower than what it currently is. Meaning, instead of buying that second property, do something else. And the reason to build it this way is that over the next couple of decades, or the next 3-4 decades, this is going to give you more peace of mind. Whereas the 60-40, which is now done, like when Morgan Stanley says it's 60-20-20, or even the Ray Dalio model. The Ray Dalio model, which you have put up here, worked fantastic in the 2010s. Long-term bonds, that was a time when people bought bonds for capital appreciation and stocks for the dividend yield. So that was a crazy period. This would have worked. Now we are in inflationary times like the 70s, so this probably would not work. And that's my take. What do you think?
Yeah, I agree. I think the idea of 40% long-term bonds is absolutely insane currently, but I do like the diversification of this idea. Now, once again, like mess with the weightings, figure out exactly what you would need going forward. But I do like the idea of, hey, you have a very small commodity basket. I would raise the gold basket a little bit more. Short dated bonds, if any bonds would be it, possibly emerging markets and US, but that would probably be 20% at most, more like 10% for me. More stocks, more international stocks, long term. Because if you're looking at long term international stocks and stocks in the US, you're probably going to continue to outperform long time. But I agree with you. I think all of these really came from the Harry Brown model, the permanent portfolio, and so many people just don't think about that. That dude was a genius for actually coming up with that idea all those years ago. Back then it was 25%, 25%, 25%. Now it's, people have tweaked it. However, the crazy thing about Harry Brown's portfolio is it still has worked. All these years later, it still has worked. So it shows you a lot of the time that, very simple diversification will work well and outperform very high level thinking of, because I think this is the thing, and maybe we'll hop off after this, but this is the thing I think about a lot with traders is they always think it's, trading is this magical thing. I mean, I'd have people hit me up when I'd work for funds and they'd be like, hey, so I want to ask a question to the trader. So what do you guys do? Do we all sit in a room and like, you're talking to a fund and in your brain, you're like, okay, there's probably 10 dudes in a room. What do? Well, they sit there and they pitch stocks and somebody's yelling at me about, I want to buy this stock and I want to buy this stock. And I sit there and I sift through all these and I write down the fundamentals and the technicals and every positive, negative about the stock. I maybe visit the damn company. I call the CEO, whatever crap people think. And then I come up with the idea. And then boom, I take that idea, I throw it in the portfolio, and you make money. That's not how any of this has ever worked. Like go like, yes, there's the person who you'll talk to who got Bitcoin when it's $5, and the person you'll talk, and who knows how much money they actually kept from any of it. So, but that's a whole other story. But then there's like the 1 in the million people who can buy one thing and did very well holding it for a long time. And that's just hard to do. It's not a repeatable process, and that's the reason why most of those people lose money, because it's not repeatable. You get into a scenario where you're like, okay, well, I did this with this stock. I bought Bitcoin at $5 and I rode it all the way to 50,000. I'm the smartest person on earth, so I should do that again. So I'll take my $1 million. Let's say I made $1 million, and I'm going to throw it into something else that's going to do the same thing. And let's say this, they buy a shit coin of some sort, which happened, and Kashab and I watched this happen to a lot of people in 2017. They buy some crazy ICO, some shit coin, they get into it, and then bam, it goes up, and they're like, look how smart I am, and then it crashes to zero, and then they can't get any of their money out of it. So that's why it's not a repeatable process. What you want to do to find a repeatable process is understand like these different asset classes, understand the macro, understand where you want to be in the market. Not to mention, don't be afraid to trade things like bonds long and short. Don't be afraid to trade commodities long and short. Don't be afraid to trade ETFs long and short, stocks long and short, whatever it is, trade them all, because there's always something that's moving somewhere that's going to help you make a lot of money, and also have more than just one position at a time. Kashab talks about it in one way, which is when you have like a trade like gold, and let's say the gold miners are working. I'm an ETF guy. I like to buy the ETFs. I don't have as much fundamental background as Kashab does, so Kashab will come in and pick some names. And so instead of doing what I do and buying the ETF and like, GDX or GDXJ, Kashab might come in and make a pick of like 5 or 6 names that he really likes in that gold mining space and go, okay, well, these are the ones I'm going to rock with. Both are diversified ways of trading, but you just have to figure out what you're going to do going forward. So, Kashab, do you have anything to add? We got to hop off in a minute.
No, I think you have covered a lot of ground, which is non-market related, which is probably a good thing because, markets are closed. Take a break, enjoy thinking of the other aspects of trading. And if you have the time, let's just get into what do you do on long weekends? Like, what do you do when the markets are closed? And then we can end there.
Yeah, so I mean, for me, what I do on long weekends when the markets are closed is I don't usually look at the market very much. I might take an hour to look at it when it's closed because I like when it's closed. But I'm not going to sit there on a 3-day weekend or whatever and go, okay, well, I'm looking at the markets and the markets are going to do this, and you're stressing yourself out for no reason. You should have most of that stuff already planned, or build scans, or build or follow someone that has scans, whatever it is, or follow a fundamental person, whatever it is, to help you to digest that information a little bit easier. Because sitting there all day, like, I have friends who are like, hey, it's the weekend, and they're traders, and they're like, I'm looking at 1,000 charts a day. I'm like, that sounds terrible. And is it helping you make money? And I've never met one of those people who's like, I'm so rich, I just look at 1,000 charts a day. I'm the richest trader on earth. I've never met somebody like that. I meet people who are like that, and like, yeah, they're knowledgeable. Yeah, they know their stuff, but it's almost analysis paralysis, where you get into points where you're like, I am looking at so much stuff to try to figure out my next trade. And not to mention, then you start to put on things that you don't really need to put on. Have your focus group. This is really important. And yes, Wavy. Have your focus group. When you have your focus group, you want to understand like what okay, for me, it's macro. And let's put it this way. So I'll just tell you exactly what I do. For me, it's macro. What's my focus group? So I'm looking at country ETFs. I'm looking at sector ETFs. I'm looking at what are the futures doing? Okay, what are the commodities doing? I'm looking at the big indexes, S&P, the Dow, the DAX, China, whatever, and then bonds. And so now between all of these, now I'm able to kind of go, okay, this is my focus group. I'm not looking at, like, people are like, I look at 1,000 charts. I don't look at any individual stocks 99% of the time. When I have a sector that I really like and I see a stock on my scan that's showing relative strength and it's doing all the things I want it to do, then I'm going to pull up the chart of it, possibly find an entry or an exit or something. That's the only way I do that. So I'm not sitting there looking at all these charts every single day. So I think that's the biggest key for everybody who's a trader, is to continue to figure out what your focus group is. Like, I think macro is very important. I think, Kashop and I, we trade just about everything that's out there. So I think that's important to have different things on there. But what it doesn't mean, I think this is a thing that happens to a lot of people, and I'll end on this, which is you go into something and you're like, I'm a commodities trader. And then, like, you look at every single commodity under the sun. Now, as time goes on, you have more money, you can do that. But you're looking at every single commodity stock, every single thing under the sun. Kashop will get questions about nickel miners, and he'll be on. And Kashop's one of the best analysts when it comes to the metals and mining space that I know. But he'll be like, yeah, I don't really trade that. Now, Kashop could go in and figure out that whole space in about 5 minutes, but he doesn't trade certain spaces. Doesn't mean he will not, but just means, like, he knows what he wants to look at. He knows where he wants to be. He knows what he's comfortable trading. And so, like, and a lot of people will look at that and go, oh my God, if nickel went up and I missed it, I don't know what I would do with my life. And it's like, well, there's another trade. There's always another trade. And, like, when I see, like, a certain individual stock and it's gone up 500x, I don't care at all. I don't even think about it. I'm focused on my group of things that I pay attention to. So try to figure out, like, what things you pay attention to. And that shouldn't be a small number. Like, it doesn't mean you have to go through 1,000 charts every, like, hour, but it just means, like, hey, I'm going to look at this focus group. I have these things that I trade, and this is what I like to do, and this is what I know more better than everybody else. And that's what I think creates an edge, is when like, for me, I'm like, I know macro better than most traders. So as long as I'm really trading that and doing well, I can really understand that. Whereas other people might say, I know this better than other people. I know this better than other people. So try to figure out your focus group. That's going to help you to do that a lot better. And then, futures, if you are really wanting to trade futures, really start to paper trade an account and really start to figure out where you want to be and how you want to integrate into futures using the micros, the minis to the large contracts. All right, guys.
I think, yeah.
All right, guys, we're going to get out of here. Thank you guys for joining us. Enjoy your 4th of July weekend. Hope you guys have fun. I hope everybody's safe and having a good time out there. Kashop, as always, thanks for joining me. We just get on here on Fridays. We just love what we do. So if you guys get a chance, hit that thumbs up on YouTube, give it a share, retweet, whatever it is. We appreciate it from you guys. And we'll see you guys next week on Friday at 10 a.m.
Thanks, Jason. Bye, everyone.